Conover, President of the York County Community Foundation. Thank you for zooming in for our annual investment briefing. I'm glad you're here safe and warm today, and I look forward to getting together with you again someday soon. You can see on the screen a few technical tips. Remember, you won't be visible during the presentation, so feel free to chomp away at your lunch. Please use the chat feature to share your questions or comments, and we will get to them as soon as we can at the end. Please switch your screens to speaker view and side-by-side view under the viewing options. You can see the presenter, the panelists, and the slides. Today is our chance to catch you up on what's happening with the Community Foundation, give you a closer look at our investment performance, and hear analysis from a financial industry expert. Like all of you, the Community Foundation has spent the last year learning new ways of working, connecting, and adapting to adapt to our changing environment. We have experienced heartbreak and felt our hearts warmed. As always, donors like you in this room rose to the challenge of 2020. We received $8 million in gifts last year, surpassing the previous year by almost $3 million. We also broke our grant-making record by awarding $6.9 million in grants to 375 nonprofits. There are countless stories of how Yorkers stepped up to help each other during the COVID crisis. At the Community Foundation, we became a focal point for charitable giving to help those experiencing hardship. We tapped into our Fund for York County to launch the COVID-19 Response Fund and engaged the United Way, private foundations, York Daily Record, and hundreds of givers to raise more than $1.1 million for the fund. Working collaboratively with the staff at United Way and county government, we met with nonprofit service providers to help us prioritize. So far, over $670,000 has been awarded from the COVID fund to provide food, housing, and childcare to struggling families. Thank you to all of you who supported this fund. Last year, we also hosted socially distanced listening sessions with Black and Brown members of our community to hear how we can better address the challenges of racism. We learned how our bias impacts our work. We were reminded how important it is to invite those impacted by the problem to the decision-making table to craft the solutions. The phrase, "nothing about us without us," was the clear message. We have since seeded a racial equity fund to focus resources on ending racial disparities. Grants from the fund will be directed by a volunteer committee comprised of people of color. This year, we will work with consultants to understand our bias and take actions to weave diversity, equity, and inclusion into all of our work. We were also reminded to focus resources on addressing the underlying causes of our community's challenges, to make grants that have lasting impact on lives and transform systems so they work better for us today and for future generations. That's why endowment is so powerful. Transformative change takes time and requires investments today and over the long term. This year, the Community Foundation celebrates 60 years of fueling community transformation. We started on this path in 1961 with $6,800. Think back to what was happening in the world in the 1960s and what you were all doing. Feel free to use the chat feature to share a memory of that time period. And don't worry, by now, I'm sure the statute of limitations has expired on whatever you did then. Years later, in 1992, the Community Foundation really began to take off. Our leaders, Bill and Corny Wolf, Bill Zimmerman, Carolyn Steinhauser, and Bill Anstein decided that if we were going to have greater impact, we needed a bigger endowment. They had a tough job because it meant changing the mindsets of donors. People had to embrace the idea that their gift today wouldn't be spent all in that same year. They had to imagine how their gift could impact multiple generations and lay a path for a better future. Luckily, they found those types of visionaries. In 1994, the Community Foundation engaged volunteers to start scholarship organizations at area school districts to raise money for scholarships. Now, we manage $9 million in scholarship funds that award more than $400,000 a year to hundreds of students. This helped transform the culture at high schools by making college an option for generations of young people. A short time later, Isabel Anderson's vision to support York's farming community became a reality when she created the $1 million Robert R. Anderson Fund at the Community Foundation. For the past 26 years, this fund has awarded $1.3 million in grants preserve thousands of acres, assist farmers with best management practices, and give scholarships to dozens of future farmers. Amazingly, the fund still has over $1 million to invest in the next generation of York's agricultural heritage. That's transformational philanthropy. At the Community Foundation, we are devoted to learning about our donors' passions and crafting charitable solutions to meet their goals for today and tomorrow. Most recently, Rick Smith of Berkshire Hathaway and his wife Carol worked with us to achieve multiple charitable goals. Their designated fund supports specific charities they care about. Another charitable fund and charitable gift annuity provides annual income. And their named fund for your county generates grants that go to our current strategic priorities, like downtown and neighborhood revitalization. We asked Rick what motivated him to give, and this is what he said.
I started selling real estate 55 years ago. And actually before that, I was born and raised on a farm out in Starview. I really enjoyed that. It was a wonderful time of my life. And now that I had the opportunity to start selling real estate, I've found another enjoyment. The enjoyment is the opportunity to work with people. I'm a people person. I love being with people, and I love serving the community. And because of that, a couple of years ago, maybe, I don't know, 15, 20 years ago, my attorney, Bill Anstein, suggested that what I do is consider the York Community Foundation, which I did. I started then a couple of years ago, 10, 15 years ago. And Carol and I, my wife and I, have given a couple of years ago, and Carol wanted her donation or contribution to be given to the Martin Memorial Library. She loves reading. My share of the contribution, I said that the Community Foundation can use it for whoever they want or however they want to do that. Actually, I have to say that downtown York, if you're talking about changes in downtown York, if you're talking about Beaver Street, there's a lot's happened in Beaver Street, a lot's happened here on East Market Street, a lot's happened on George Street. There's been an awful lot of action. Actually, there's a big change in downtown York in that respect. I saw just last week, my granddaughter, Tibby Brenner, who is 11 years old, did a video for the Girl Scout cookies. And the video, in essence, the theme was, it's really nice to give, because when you give, you feel good about giving, and the person who receives the gift feels good about giving. Yeah. But in any event, in saying that, I do think it's really wonderful. It's a wonderful thing to give, and it's a wonderful thing to help your community, especially a community that's been so wonderfully important to me. So here's the situation. If you want to give back to the community, this is a perfect way to do it. York County Community Foundation is wonderful. They'll disperse the funds accordingly. They'll disperse the funds where they need it most, and they'll do the right thing by doing that.
We're so happy to be able to work with donors like Rick and Carol and help them achieve their goals. Donors like the Smiths that built the Community Foundation over the past 60 years envision a better future for their children and their grandchildren. That's what we're focused on. We must continue to grow and work together in new ways for a more prosperous York County where everyone can thrive. Thank you all for joining us on that mission. Our investment strategy also takes the long view and aims to grow and preserve assets for future generations. We are grateful to our outstanding investment committee and fund advisors for taking great care of our donors' legacies. To tell you more about investment strategy, it is my pleasure to introduce the chair of our investment committee, Holly Mayer. Holly is first vice president of Mayer Wealth Management of Janie Montgomery and Scott. Sorry. There you go, Holly. It's all yours.
Thank you, Jane. And good afternoon, and thank you for joining us today. As Jane said, I'm Holly Mayer, chair of the investment committee, a role I've been grateful to serve given the foundation's impact in our community. I'd like to start today by thanking the following people. First, the foundation staff for their work in supporting the community every single day. To George Dvorak, Vice President of Finance, for his steadfast guidance to our committee. To the investment committee members, and I'll introduce each of them: Robert Bowen, Richard Harley, Bill Hartman, Nancy Clayhold, Todd Marsteller, Paul Rudy, David Civil, Oliver Orr. Each of you bring a wealth of experience and commitment to your roles. In 2020, this volunteer group of local experts worked with our two investment advisors, Mason Investment Advisory Services and Commonfund, to continue managing our portfolio. Under the guidance of our two investment advisors, we will continue to seek out investment opportunities that enhance our returns without taking undue risk. Because we know that investment markets can be volatile, we focus on long-term returns, as they are the most important indicator of our ability to create a permanent legacy for our donors and provide a perpetual source of income for the betterment of York County. Our investment objectives reflect why investment returns matter. We want every permanent endowment fund to have the same purchasing power 20, 50, 100 years from now as it does today. This means we seek a long-term investment return that covers our annual grant making, which is normally around 4.5%, and also covers fees and inflation. Jane shared earlier the story of Isabel Anderson, who gifted York County Community Foundation $1 million to support her passions of agriculture in our community. It is because of our long-term investment strategy that her fund has granted more than $1.3 million while still maintaining its original contribution. 2020's return of 9.7% means that an additional $13.4 million added to the endowment this year. That translates into an additional $600,000 available each and every year for grant making. To accomplish this within acceptable risk parameters, our portfolio is diversified among three broad asset classes. Global equities or stocks make up 66% of our portfolio. Global fixed income or bonds account for 12%. And diversifying strategies such as hedge funds, REITs, and natural resources capture the remaining 22%. By diversifying our assets by both asset type and managers, we strive to ensure that low returns in one area will not significantly impact the entire portfolio. Following a 21% return in 2019, 2020 was a year marked by unexpected challenges, uncertainty, and rapid pace change for all of us. Nearly all our 2020 forecasts proved to be inaccurate, as our investment managers navigated through a pandemic, an official brief bear market, an economic shutdown followed by a seemingly instant rebound, and to end the year, a chaotic election process. Market indices set new highs, primarily swayed by record-setting performance in concentrated areas such as technology and growth stocks. Well-diversified portfolios such as ours were not nearly rewarded to the same degree as the industry highs, but we still achieved honorable returns, increasing our endowment portfolio value. As I mentioned, our 9.7% return this year added $13.4 million to our endowment. Going forward, 2020 reminded us to build on our solid foundation and to stay grounded into what we know is true. We'll do this by investing in good fundamentals with long-term potential, keeping our commitment to allocate dollars to our private capital strategies for enhanced return opportunities, and to remain disciplined to our diversification. Our top priority will always be to continue to invest the capital entrusted to us to honor our fund holders' legacies. The expertise of our investment advisors, along with our investment committee's local oversight, gives us confidence that our endowment is well positioned to continue to meet our investment return goals and increase our grant dollars for years to come. We are pleased that both of our investment advisors are here with us today, and you will have a chance to hear from each of them along with our guest speaker. Mason Investment Advisory Services has been a valued partner of the York County Community Foundation for the past decade. A listing in Barron's America's Top Advisor Rankings, a listing in Barron's Top 20 Institutional Consultants, a listing in Forbes as a Top 50 Wealth Manager, and a listing in Fortune magazine as the Top 50 Investment Advisor are just a few of the accolades that the industry has honored them with for their service and dedication to their clients. To say a few words about the firm's relationship with the foundation and its donors, Please welcome Bill Corson of Mason Investment Advisory Services. Bill?
Thank you, Holly. Good afternoon, everyone. Thank you for your invitation and continued confidence in Mason Investment Advisory Services. As Holly mentioned, my name is Bill Corson. I'm a Senior Managing Director with Mason. I've been with the firm for about 4 years and in the industry for over 30 years, including time as a Chief Investment Officer of a $10 billion public fund. Working with large directed portfolios is something that I've been doing for quite some time. And having that experience, I think, is applied to this particular opportunity as well. I'm honored to be with you again this year. Much has happened in the world since we last came together, and I hope you're all safe and healthy. In the past year, we've seen some of the best in people. We've also seen some of the worst, but we can take a page out of the investment market rule book. They tend to look forward for direction. This year, markets, as Holly mentioned, have shrugged off a number of things, including political controversy, increasing national debt being another one. But markets are beginning to see greater hope to the end of a global pandemic. Tailwinds are forming and headwinds are beginning to subside. While hope is not a strategy, it does contribute to our desire to continue to move forward. As an investment manager specializing in institutions, particularly nonprofit organizations, our work is laser focused on helping our clients respond to the needs of our collective constituents. Jane asked us to share our thoughts in particular on diversity, equity, and inclusion. We're very proud of the work that the York County Community Foundation has done and focused on that. A note from our president, Scott George, states that we feel there's a real value to our organization to work toward a diverse workforce, to make any real progress in this area, and to work with organizations who foster career development initiatives. And we are working to that end. And as Jane said earlier, a transformative change takes time, but we are working to that end to make sure that we can all take advantage of the benefits of diversity, equity, and inclusion. So with that, I thought for those of you who are spending the first time with us, or maybe a little bit of a review, I thought I'd share a little bit about Mason Investment Advisory Services. First, we do manage a little over $8 billion in assets. We also report on other assets that we don't actively manage, taking that total to a little over $9 billion. Our institutional clients, there are 80 of those, and with minor exceptions, they're all nonprofit organizations. And of those, 48 are community foundations. We work with community foundations as a partner in their goal to focus on the community and increase the work within the community. So as a partner, in addition to managing the portfolios, we also work in educating the staff, investment committees, and the board. We've also worked with donors in their understanding of the investment markets and the benefits of the investment pool of the community foundation. Of all the things that we bring to the table, there's one thing that we don't bring to the table, and that is proprietary products. We, as a partner, prefer to sit on the same side of our clients, and as a result, we want to be able to recommend securities and investments that we don't have an inadvertent bias towards. So no proprietary products for us, and for that, we're particularly proud. We are a national firm. We actually have clients in 43 states, as you can see that map there. We have a little over 65 employees right now, and we've been around since 1982. So we've been around for a long time, working with institutions, particularly community foundations. We continue to grow that part of our business as the needs of each organization is very unique. And as a boutique firm specializing in this type of organization, we're able to respond to those unique needs. And as you can see with our national exposure, our clients have been able to respond. So with that, I'd like to once again say thank you very much for inviting me and Mason Investment Advisory Services to be in front of you today, and everyone stay safe. Thank you. Holly?
Thank you, Bill. York County Community Foundation, in addition to working with Mason Investment Advisory, has partnered with Commonfund. We began working with Commonfund in 2014. They are an asset management firm founded in 1971 with a two-part mission. First, to create investment solutions and access to managers and strategies through private capital investments that nonprofits could not attain on their own. And secondly, to create educational programs that could bring current best practices to institutional investors of all sizes and segments, including York County Community Foundation. It has been ranked as one of the top 10 most trusted institutional asset managers for nonprofits by Market Strategies International. I am pleased to introduce Kelso Morel from Commonfund to tell you more about their expertise and to also introduce our guest speaker today. Kelso?
Thank you, Holly. Good afternoon, everyone. Can you hear me okay?
Yep.
Great, thanks. I'm pleased to be here today. I echo Jane's hope that maybe next year we can do this in person. I enjoyed the luncheon that we had together last year. Sarah, if you could go to the next page for me, please. Great, so a little bit about Commonfund. I'll be brief because I really want to turn the floor over to Daniel Cook, our speaker, in just a moment. But before I do that, Holly asked me to spend just a moment talking about Commonfund and our efforts around diversity, equity, and inclusion as well. Commonfund has been around since 1971, so we're pleased to be celebrating our 50th year working for the nonprofit investment community. All of our clients are nonprofits. We manage about $25 billion across all asset classes, and we use third-party managers like Wellington, who has been a partner of ours since 2004. I spoke about Wellington on purpose because Daniel Cook is going to join us in a moment, is a market strategist at Wellington. And for those of you in the audience, just to give you a brief flavor, Wellington manages 2 equity portfolios for us in our Global Equity Fund, which is one of the funds in which York Community Foundation is an investor. If you go to the next page for me, please, Sarah. Great, so as I mentioned, Jane asked us to talk about diversity, equity, and inclusion, what we call DEI. And we think about it through 3 lenses. We think about diversity, equity, and inclusion within our own people at Commonfund. We think about it within our investor management universe, and we think about it in terms of thought leadership, the work that we do to share with others. We've put a couple of blogs on our website, for example, and we partner with many organizations, including the Robert Toigo Foundation you see down at the bottom. We are sponsors of Girls Who Invest, and in fact, several of our employees came to us as summer interns through Girls Who Invest, are now permanent members of our team. So we think diversity, equity, and inclusion is increasingly important in organizations, and it can be everything from reaching out to HBCU colleges to help with recruitment, to working with our partner management companies, and then of course we have just started our diverse manager portal, which many of you may have read about. The Diverse Manager Portal seeks to reach out to emerging managers that maybe don't have access to big institutional flows of capital and seek to use those within our portfolios where appropriate. I'm going to now turn it over to Daniel Cook. I'm very excited that Daniel's going to join us. Daniel is a CFA holder, and he is a portfolio strategist at Wellington. As I mentioned, we've been working with Wellington since about 2004 in some of the equity programs that they manage. And he's going to be talking about, is the rotation real? So Daniel, I'm excited to hear what you're going to say. I turn it over to you. Thank you.
All right, thanks a lot, Kelso, and thanks everybody for having me. I appreciate your time. So before we get going, there are a few housekeeping items I'd like to go through up front. Number one is the fact that Wellington, where I work, has no chief investment officer. We're intentionally designed that way. We feel like it encourages independent thought and diversity of thought and collaboration. And so these views are just my views. I want to be clear that they don't represent a house view, and they may actually be different from the views of the portfolio managers in the funds that this particular client is invested in. The second thing I like to say up front is just time frame. So my time frame is 1 year. So every quarter I update my multi-asset outlook, but I'm always thinking about the next 12 months. And then finally, just to elaborate on my role a little bit more. So I work on our multi-asset investing team. And so my group manages multi-asset, generally speaking, top-down oriented, so macro-oriented strategies for some of our institutional clients. And my role in that group is to do research and to have a view across different regions and across different asset classes. And so since clients often want to hear views across different regions and across different asset classes, I also spend a lot of time speaking to clients and enjoy that role quite a bit also. All right, so now that the table is set, let's hop in. So on the key points page, so there's really, in my eyes, three main reasons to be bullish on risk assets. And those reasons are, number one, we've seen very encouraging vaccine data. Number two, a lot of policy support. And number three, we're starting to see economies that should be reopening quite soon as a result of the vaccines allowing some return to normalcy. And so that makes me a lot more confident in taking a pro-risk stance over the next 12 months. So on the vaccines, if you remember back in the fall, we were hoping for vaccines that were, say, 60% effective and safe. And it turns out we now have two that are 95% effective and very safe. And we have, a host of others that aren't quite as effective, but nonetheless, much more effective than I think what anybody could reasonably have hoped for. So I think that, that's been a major upside surprise. The science has really come through. And so I do think that that's going to allow the economy to reopen. So in terms of policy support, we've seen a lot of fiscal policy support. We've seen a lot of monetary policy support. Importantly, on the monetary side, policymakers have really been hammering home the point that they're not going to remove policy stimulus too soon. But I think they really learned the lesson of post-GFC or post-financial crisis, and they're really going to lean into that policy support. So I don't expect the punch bowl to be taken away, if you will, anytime soon. And so that should continue to support risk assets. And then finally, the reopening economy. It's important to note that in this particular recession, for the most part, incomes were not that affected. And that's largely because fiscal policy was able to replace incomes or supplement incomes for a lot of folks. And so we had a situation where incomes, yes, they went down, but not that much. But at the same time, spending did go down quite a bit. And so that means that savings has gone way up. So household savings has gone way up. People have money to spend. And so when the economy starts to reopen and when people have the confidence in the economy, that should allow kind of a snapback in spending. And so that should really be one of the tailwinds that was mentioned earlier. Bullet point two is that these vaccines, this vaccine-driven reopening should be the catalyst for a durable rotation from growth to value-oriented areas. So away from the safest equities, i.e. large cap US equities, and toward some of the more value-oriented or some of the more cyclically exposed, i.e. these companies that tend to do better when the global economy is doing well. So they're very sensitive to changes in the global economy. And so I think that finally, really for the first time since the financial crisis, I think that the macroeconomic backdrop could be one that is supportive of these companies that really need to see economic growth come through in order for their revenue growth to increase. And so what I think that means from a more practical standpoint is within equities, I prefer Europe, Japan, emerging markets, and smaller caps. So these, again, are all areas that are very exposed to the global economy, very sensitive to changes in the global economy. And also, I would note that those are areas that have been very, very cheap. And so those areas have been cheap for quite some time. And a lot of market participants will know that, we've been hanging around waiting for years for those areas to start to outperform because they're so inexpensive. There's always this feeling that they would start to do better. They're so cheap. You have a big margin of safety. But what we learned in practice, unfortunately, is that these cheaper areas really need a catalyst to start to outperform. And so my bet is that this vaccine-driven reopening is finally the catalyst that's going to allow these cheaper areas of the markets to outperform. So on the interest rate side, I do think that interest rates are going to drift higher, but I still think that some areas of credit markets are attractive. In particular, I would focus on the areas of credit markets that have less sensitivity to rising interest rates. So rising interest rates are going to be a lot more punitive to what we call longer duration areas of the credit markets. In particular, that would be investment grade credit. So I would shy away from investment grade credit, and I would lean more into high yield, where spread changes are going to be a much greater piece of total returns. All right, so that is a relatively optimistic outlook. I will admit that there are certainly plenty of risks to that. I think the number one risk is, of course, COVID. And in particular with COVID, I think there are really two things to monitor. Number one is the vaccine take-up rate. So I think right now we've proven that we definitely have the capacity to vaccinate a large percentage of developed markets this year. But what is less clear to me is what is the willingness of people to actually take those vaccines. So that's a major thing to watch. We have a slide about that. So I will spend a little bit of time talking about that. So that's risk one with COVID. And risk two with COVID, as we're hearing about more recently from the experts, that would be the risk of new variants that escape the vaccines. And so if the South Africa variant, the Brazil variant, or some other unknown variant, if it turns out that makes it so that the vaccines are not nearly as effective, then that could mean
Hello all, I'm sure Dan is working on his audio, so stay tuned. We'll be back with you shortly.
Can you guys hear me okay now?
Yes,
All right, my
we can.
apologies.
Yes, we can.
That was my phone dropped the call, which I apologize for. We logged in about an hour earlier to check the tech, and I guess it should have been 2 hours earlier. So my apologies on losing the audio there. All right, so as I was saying with COVID, one of the major downside risks would be if these new variants make it so that vaccines aren't as effective. That would lead to, I think, a situation where the economic snapback that I expect becomes more of a crawl back. And I think that's something that the market does not expect. And that would be, in my eyes, a major downside risk. So on to the next slide, the multi-asset views slide. So I can give a quick rundown of what I'm thinking across different asset classes. So I am moderately bullish overall on developed market equities. I have a neutral view of U.S. equities. I want to be clear, I do think that the U.S. economy is going to perform quite well. And I do think that the equity market will do fine. It's just that I prefer investing outside of the U.S. right now. And the reason for that is because the U.S. equity market is very geared toward the safest areas. And I think that the riskier areas, the riskier sectors are going to do better. And when we find those areas and we find those companies, generally speaking, outside of the U.S. So I think that international is going to outperform the U.S. For the first time in quite a long time. So moderately bullish outside the U.S. I'm moderately bearish on commodities. The reason for that is because while I think that inflation will pick up some this year, it's important to keep in context that inflation is unbelievably low right now. So there's a lot of room for growth to go up before inflation starts to rise materially. And while I think that commodities certainly play a structural role in portfolios, I think tactically speaking this year, that would be an area that I would consider to be a source of funds. On rates, I think that rates across the board are going to drift up as growth comes back. And on credit, like I said earlier, there are select areas of credit that I like, high yield being one of them. I'm moderately bullish on high yield. It's an area that tends to not get punished as much by rising interest rates. And there are certain areas within high yield that I know our team is pretty excited about. And finally, securitized assets I like. So the reason for that is because I think that there's a lot of kind of structural reasons to like the U.S. housing market. And I think COVID really exacerbated some of those. So I think there are good tactical and structural reasons to like U.S. housing, and securitized is a great kind of lower risk way to get exposure to U.S. housing. So on the next slide, a year of high volatility and down and up markets. Just want to quickly, not to punish everybody, but I want to quickly take a look back at 2020, although I know everybody wants to put that disaster behind us. I think there are still some important lessons to be learned from markets. And so the slide is looking at the percentage of days that the S&P 500 was up or down more than 4%. And so we see that not until we had to go all the way back to the financial crisis to see a time period that was so volatile. But what I want to draw your attention to is the fact that there were about an equal number of days where the S&P 500 was up more than 4% as there were days when it fell more than 4%. And so I think it's a healthy reminder that timing the market is very difficult. And so it's always important to have a good kind of structural asset allocation plan in mind and invest more with the long term in mind than trying to play the ups and downs and the dips of markets. So on the next page, the low probability of a progressive agenda. So I want to spend a moment here up front on politics, as it's a major concern that I've heard from clients. And they ask about, the risk of a progressive agenda as the Democrats now hold the White House, the Senate, and the House. And so it's important to realize, I think, number one, that in Congress, the Democrats have the slimmest of margins. So in the Senate, it's a 50-50 split. And as the chart shows, in the House, it's one of the slimmest margins that we've seen, really throughout history. And so I would interpret this as not a mandate to make wholesale kind of structural changes to the U.S. economy. So this is not a Bernie AOC-led path to socialism, but I think there are two big implications and two major things I want to talk about. Number one I think that we're going to see a big increase in fiscal support. So I think we're going to see that at some point during the first quarter. And number two, I think that we are going to see a shift toward redistribution. And so that word used to be anathema to most economists. But since then, since those ideas went mainstream, back in the days of Milton Friedman, really popularized by, Reagan and Thatcher, et cetera, since those ideas were kind of all the rage, there's been some major changes, big picture structural changes. And one of those has been income inequality and really inequality more broadly. And so that has gotten a lot worse. And it's now a major theme in the economics discipline. And I would note that it's really not the fault of fiscal conservatism. It's really because of technology and globalization. Those things have really driven inequality. But nonetheless, addressing inequality is going to be, I think, a major goal of policymakers on both sides of the aisle. And so I think what we're seeing right now is, in terms of the increase in fiscal spending that I expect, I think that we're seeing a reaction to COVID, but also an attempt to try to move the needle on inequality. Because again, that's really become a bipartisan issue. So big picture, I think what we're going to see out of the US is a step in a progressive or a liberal direction, but definitely not a headfirst dive into socialism. All right, on the next slide, mobility is still well below prior levels. So this is just a quick look at where are we right now in the economy. So there are many economic indicators that are useful. I think this is a particularly cool one. It's a new one. It comes from the Dallas branch of the Federal Reserve, and it is the social distancing index. So it shows that when COVID happened, people were isolating quite a bit, and since then we've really clawed back, but we're still down around 40%. And so economic activity, as measured by mobility data, shows that we have a long runway to get back to normal. And so hopefully, as we have a vaccine-driven reopening, the economy has a pretty steep and pretty long runway to get back to normal. So the next slide, COVID vaccine take-up rate is improving. So I want to spend a little bit of time talking about the vaccine. So keep in mind here that the big picture is that the vaccines are incredibly successful. They should be a game changer for the economy, but that doesn't mean that there aren't some lingering concerns like I mentioned up front. Number one would be the vaccine take-up rate. So up top, we see that back in September of 2020, there was a good bit of people. So it looks like here, if I could move this up.
Oh, this gives us a chance to take a look at this slide and figure out what it's saying. Hopefully Dan will be back again in a moment. Bear with us.
Dan, this is Sarah. If you can unmute your phone, it's showing as muted.
Oh, my apologies. Sorry about
Thank
that.
you.
My phone was unmuted, but on Zoom it said it was muted still, so my apologies. So as I was saying, what this chart is showing is that people are increasingly willing to take the vaccine as we've learned that it is more effective than what we previously thought it would be. And therefore, we passed one of the major hurdles, and that is getting people willing to take the vaccine. So now it's really all about the variants. The variants are, in my view, really the last hurdle before we can start to think about putting the COVID situation behind us. So on the next page, shifting consumer spending trends. So this comes from our investment science team. They broke down hundreds of millions of different credit card transactions in the US. And so you see that there are certain areas of the economy that have gotten crushed by COVID, but there are actually some areas that have done much better. And so in economics, we call this wallet share. Not sure who invented that phrase, but nonetheless, you see that areas like home improvement have done incredibly well. So yes, spending is down, but important to realize and appreciate that some areas have actually done quite well. The next slide, the record cash on the sidelines. So what this is getting at is the fact that, it's not a secret that we should see a vaccine-driven reopening. And so, how is that not already priced into markets? And how are we still optimistic despite the fact that it's very obvious that the economy should do well this year? And the answer is, because A, valuations in certain areas are very cheap, and B, there's still a ton of cash on the sidelines. So that's what this chart is showing, that money market flows have still been really strong. So there's a lot of cash that should still come back into the market as the economy starts to improve. So the next slide is looking at China's recovery, which is migrating to the services side of the economy. So this is a structural story, but you'll see that COVID has really exacerbated this, and that the services side of China's economy is starting to do better. So these are gauges of different areas of the economy. So the light blue, the services, is doing better. And on the next page, the Chinese equities weighted toward consumer, you see that that's a good thing for investing in Chinese equities, because the equity market tends to be very focused on consumer-oriented areas. And so it's one of the reasons why I think that China is going to continue to do well from an equity market perspective. The next slide on gold. Gold can enhance portfolio diversification. So just on the fixed income side, which is of course the area that we want to do well when equities are doing poorly. So we can invest in areas like TIPS or high quality government bonds. We see those in darker blue, but you'll note that gold tends to perform very similarly. So yes, starting yields are very low, and that may make fixed income less attractive. But the good news is there are alternatives, and one of those would be gold. That's what I'm highlighting here. So gold could be an area where we could see some diversification benefits. And then the second to last slide I wanted to talk about is this ECB QE has pushed European investors into credit, which hopefully I can succinctly translate into English. So one of the areas that I like is US credit markets, but there are areas in the US credit markets that are really expensive, I will admit, but I think it's still a pretty good environment to be in areas like high yield, because the US economy should do well, because the demand for yield from investors is so strong, and also because of this chart. So the dark blue kind of shaded section, that represents the European Central Bank's quantitative easing. So they're buying bonds, they're buying high quality European government bonds. And so what that's doing is it's forcing investors then, they're selling their bonds to the European Central Bank, they're left with cash, and now they need to invest it. And where do they go? Well, they need a higher yield, so they go to US credit markets. And so that's what we see with the darker blue there, the net purchases of foreign debt. And so a lot of the flow coming from the European Central Bank has actually ended up in US credit markets. And that's a phenomenon that we expect to continue. And it should be a really supportive technical reason to like some areas of US credit. All right, I'm going to wrap it up on this slide, the diversify exposure across economic environments. So this is what our team likes to call think function, not form. And the whole idea here is that you can break down economic environments into 4 distinct regimes. And so if you think about growth going up or down or inflation going up or down, you can kind of separate out these 4 different boxes. And the asset classes are plotted in the areas in which they tend to do best. And so the whole point here is that if you like equities and you hold a lot of equities, if you want to get into high yield, you have to realize that high yield still is going to do well in an environment in which equities does well. So it's always important to stress the bottom left. So that's the area with high quality government bonds. So if we're wrong, if I'm wrong, and if growth or inflation goes down, that's the area you're going to need to have. They play a unique role in doing well in that environment. And then in the far right, and this is something that I would be thinking about later this year, is commodities. So if inflation picks up, as I expect toward the end of this year and next year it will, commodities are really the thing that you want to be holding. They're the only asset class that's very sensitive to changes in inflation. So if we do end up in the out years with higher inflation, commodities, I think, is definitely the place that you want to be. And then the putting it all together slide is a verbatim repeat of the intro slide. So I will not put you through the torture of hearing me go through that again. So I'm going to stop here. We're at 12:51. But I'm happy to hang out and answer any questions. And my apologies again for my phone issues.
Daniel, thank you for a great job. Your presentation was so informative and so thorough. We really, at this point, just have one question from the audience, which I'll pass along to you. The question is this: Daniel, regarding your reopening optimism, how much have you considered the potential impacts of businesses that have closed permanently and significant numbers of people who are unemployed and or underemployed?
Yeah, that's a great question. And so I think that we are going to see, I think that the small business side is definitely an issue. So I think that, one of the implications of that could be at some point higher inflation, just as our ability to supply goods and services to the market has been curtailed by COVID, causing some small businesses to unfortunately go under. So I think that is one of the reasons to be a little bit less optimistic. I think that's astutely pointed out. On the consumer side, though, what we've seen is that there are a lot of folks that have been fortunate enough that their jobs really haven't been affected by COVID. So that tends to be the more successful white collar side of the economy. And then for the people that are unfortunately more directly affected by the COVID recession, luckily, fortunately, the federal government has done a lot to help out those people. And that's something that I expect to continue in the near term. I think that we're going to see another big dose of fiscal stimulus that's very much geared toward helping out the people that need it the most. And so hopefully that can tie them over until we do see the the vaccine-driven reopening that should lead to stronger economic growth.
Great, thank you.
Good afternoon, everyone.
Thank you. My pleasure.
Hi, I'm Mary Kay Bernosky. I'm the Vice President of Development for the York County Community Foundation. And on behalf of our President and CEO, Jane Conover, all of our board and staff, I'd just like to thank everyone who was involved in making today's program a success. In particular, our speaker, Daniel Cook, who overcame some technology challenges to give us a truly good basis for optimism in the coming year. To Holly Mayer and our investment committee for their dedicated stewardship of foundation assets. To Rick Smith for generously sharing his relationship and the story of his work with the Community Foundation with us. To all of our staff, but in particular, Dorinda, Sarah, and all of our finance team, George Dvoriak, Donna Jones, and Michelle McKinney, who made today possible. And most importantly, to all of you who took the time today to share yet another Zoom meeting, one that we hope you found both illuminating and instructive. And we hope very soon to see you in person. We wish you all great health and prosperity in the new year. Thank you.